All right. Good morning, everybody. We have Bosick speaking again this afternoon. This says 2:30, so he'll be speaking around 3:30. We've had a lot of Fed speakers in the last few days, all wanting to come out and put in their hawkish tilt to the market, kind of help Powell out a little bit with this idea that they're not going to pivot anytime soon to kind of get the market to back away from that idea. It's all about peak earnings right now, right? They've popped every other bubble. The only bubble left to pop is that that peak earnings bubble. We've had demand destruction, and this is just the next one to go. It's all about the jobs this week. The Fed has made it clear that they want to see a consistent, persistent trend in inflation. So the numbers are, of course, going to be heavily scrutinized for any signals or signs that things are trending in the right direction. And this is one of the times where it seems like they've got their head firmly on their shoulders instead of somewhere else. Inflation is a living thing, and they have to kill it. They have to beat it down into submission and make sure that it completely goes away. Otherwise, if they don't get it done and they only put a dent in it, it will come roaring right back again. And it's self-sustaining. So once it is there, it will continue to sustain itself all on its own. It's crazy. Europe and their energy crisis is still front and center. Behind that, China is back into lockdowns again, and that's going to obviously affect a lot of things. Add to that the NVIDIA news last night, where the Senate and the House has moved to enforce some kind of new restriction on how tech companies interact with China. Right? You can read the articles, but basically they have to get permission to sell certain components or products or whatever. So NVIDIA took a hit from that. AMD went with it. I think MU had a little bit of bleed on there as well. So there's that side of things. Otherwise, we just continue to play what we have. The rotation out of energy into tech. Here's the jam, though. If we don't actually rotate into tech, but we do rotate out of energy, we're going to get a lot of volatility, right? The volatility will absolutely pick up. So we need to rotate into something. Now, every day I look at the put call, not the put call, the buy side versus the sell side of MOC orders. And if you use something like Market Chameleon, they use a little bit of a benchmark of, say, 50,000. And if the number is greater than 50,000, then they'll keep track of it, right? It's an order imbalance thing. And in the last week, which is what we're looking at right here, from the 25th, 26th, 29, 30, and 31, the numbers were, pretty much in line, like a 130 to 60 or a 60 to 190, 108 to 90, not, out of line. Look at yesterday's number. The buy side 256, sell side 290. What does it mean? I haven't had a chance to see what was bought and what was sold yet. I haven't parsed through the data yet. So, they could have been getting that rotation finally started, getting out of one side of something and getting into the other side of something. But the big number alone stood out, got my attention, needs to be dug into a little bit. We're certainly in a change environment, right? That's a big change number. Now, what comes from it? I don't know. Keep in mind that it is a 3-day weekend, and next week will be a short trade week, right? 4 full days. I believe the futures will be open on Monday, limited time, but the stock market won't be. All right, full house today, 7:30, 8:30, 9:45, 10, 10:30, 11, 11:30. There are additional auctions in there at 11 and 11:30, but we don't have a 1 o'clock auction today, which is nice. So once we get past 11:30, really the only thing we have left is Fed speakers. And at the moment, it's only Bostic that's on the deck, but like we've seen in the last few days, others can just pop up. So even though there's nobody left on the docket besides him, keep your eye on Finance Juice or wherever it is you get your news to see if a Fed speaker just happens to pop up somewhere and starts chipping their teeth. These numbers go directly in line with what we've been talking about, right? You want to keep your eye on anything that talks about that China lockdown more, because that's going to greatly affect what's going on. And then anything that's going to affect earnings in the new cycle coming up, right? They said that the last quarter, they said that was the last good quarter for a while, and let's see if that plays out, right? Obviously, we got to start that off, and banks will kick that off. But look at the headlines on layoffs and reduction of companies, and I believe this morning there was 2 new big names that said they're going to start cutting staff. And it goes right into this, right? And then the costs right into that inflation discussion. It's the numbers that the Fed is looking for. Now, they really like the PPI, and the rest of the market likes to use the CPI or vice versa. Just keep track of those two along with the FOMC itself. You'll be pretty good. I mean, these other ones, of course, they matter, but to varying degrees. All right, the volumes today are within our levels. We're not out of line. Kind of just maintaining the. We were better off yesterday, but still underneath the extreme average. So, that's a hard number to read, white on a white background like that. But it tends to trend right around that 100 level for 7:30 in the morning, right? For this time of day. And we're right in that zone. So, all right, just like yesterday, there's 3 things that we can do. Hold the line, break to the downside, break to the upside. Well, we've already broke to the downside. We are outside of yesterday's price action. So we are in an inside day breakout. At this point, the question is, are we going to keep it? So one of the things that we want to do is recognize where the pivot points are at. We are underneath the daily pivot. They call that an MDP, a missed daily pivot. We haven't hit it yet. We might not hit it at all. A missed daily pivot is a trade strategy. We missed this one back here. Probably can't see it too well in the stream, but the floor pivot was right there for the day, and it was lined up right in line with that weekly. Either way, we didn't hit it. Morning, Brian. So we haven't hit this one this morning. Be keeping my eye on that as a lineup. The argument for today is, are we going to get back inside the line? Are we going to get back in that base? There's also the weekly expected move. So as you can see, we're just crossing through it. There's the weekly expected move low. To get a little bit of a visual on what that low is, come out to this time frame here. So every Friday, we get the weekly expected move level, and that is the level that we had from last Friday, from 826. So we had our weekly expected move high and our weekly expected move low, and we breached outside of that this morning, and we're working to get back inside that line. A couple of things that go with this is that the market closes on that line, on one of these lines, way more than it statistically should, right? It's a $4,000 product. In 7 days, it could move wherever the heck it wants. And yet statistically, it'll close on one of these lines way more than it ever should. And it's not random, right? And it's not in equities. You can't go put this thing on like forward and then complain that it doesn't land on the line. There's an average of around 40 million options traded every day. And out of those 40 million options, nearly 1/3 of all options are focused on the S&P 500 in some way, shape, or form. The VIX is the S&P 500. So then you've got SPY, an ETF of the S&P 500, and you got the SPX. You put all those options together, and you're looking at least 1/3. And then there's the old adage that SPY is Apple and Apple is SPY, and that the FANGs are pretty much just the indexes themselves, because the index will do what the FANGs do and vice versa. Now, whether you set the MOT argument aside, the monsters of tech, and you only look at, say, VIX, SPY, and SPX, you're still looking at 1/3. So whatever the S&P does, that's what the market does. And it closes on this line way more than it should. And it's based on what the algorithms are designed to do. They'll go in and they'll trade the basket. And they will hedge against that basket using the ES futures. Futures have a hard delta. They're trying to get back to delta neutral. When we break out of this box a little bit, it's not that bad. If we break out of this box 1 standard deviation, the algorithms will really ramp up. And what they have to do is sell into selling. So the more we fall, the more not delta neutral they are. They have to sell to get to delta neutral. Them selling the ES futures will drive us lower. That drives the entire market lower. That gets us farther away from the box. They have to sell again more to get back to delta neutral. Their selling causes more falling. It's a vicious loop that ends on Friday, because the options trades that are being placed are from Friday to Friday on these levels. They'll straddle or strangle one of these levels. We don't often know which one it's going to be. Now, this is something that if you were to constantly or commonly read a lot of headline news and actually get into the articles itself, where it talks about dynamic hedging or gamma hedging or dealer gamma hedging. Look for articles like that, and it'll have this discussion in it, right? You got to kind of pick the pieces out and slowly build the logic of what it is that they do, right? It's not like I just read a book that laid all this out for me nice and easy. But those would be the kind of things you would want to search if you want to dig deeper into that kind of logic. Gamma hedging, dealer gamma hedging, things like that. That's the kind of keywords you want to look for. So keep your eye on that expected move today, because if we are starting to get a little too far away from it today, it's going to activate some dynamic hedging. And then the selling is really going to pick up steam. Now, while we're out here, go back to that indicator that I built a while back, asking how far away from the 10-period moving average are we? Right now, we're looking at the weekly, and we're not very far away from the weekly at this point, but we're getting near the year-to-date average of how far away from the 10 we get before we tend to pause. What we're really trying to ask here is, have we moved too far, too fast in a small period of time? Not yet, at least not with that 10-week. But there's also the other metric, the 10-day. And I find this one more dynamic, especially for my short duration analysis, right? And the S&P. If I'm looking at Apple or whatever, I'm probably going to use the weekly more often than the daily. But when it comes to the S&P and the NASDAQ, the daily is really closer to the kind of time frame that I trade. So year to date, meaning we started this in January. I don't have the chart set to a 1 year, just from January 3rd. Where's the average turnaround? How far away from the 10 does the S&P usually get before it stops there and turns around and goes back, or it stops there and lets the market catch up with it? It's around 3%, and that's where we're at, near that 3%. We've gone lower this year, farther away from the 10, right? That big sell-off in the end of May and the first week of June. We moved hard and fast in a single direction for an extended period of time, and we got to around 6%. But on the year, that was the worst of it, and we've been averaging around 3%. Well, we're getting into that spot. What this really is showing is that we're not out of line, but we are getting to a spot where we're going to start looking for a pause here, a little bit of consolidation. Now we're looking at a full year. And I think the argument could be made that around 3% seems to be the spot where we reverse. If I was trading, say, options on SPY rather than ES futures, if we start getting into 5%, 5.5%, I'm probably going to take swing long on GP, on general prerogative, right? Just because we've gone that far. It lines up perfectly with Tasty Trades and that strategy that they made, aggressive contrarian trade strategy. They went all around the United States teaching that strategy after they got all the numbers. And it's an interesting strategy. I don't trade it the way that they taught it, but still interesting. So 39.43, you could just mark that line with your drawing tool. All right, so the argument for today, are we going to get back inside that box, inside of yesterday's price action? Or are we going to continue to decline even more? For the decline argument, since we're already outside of yesterday's price, I want to use that quant tool. Now, if you're on a broker that doesn't have this, just use your Fibonacci. Add 1.5 and 2.0 to your fibs. We're looking at the Globex low to the Globex high. That's our range, right? If we were to think about that as a box. And as with any technical analysis, you measure the head and shoulders, you measure the wedge, the flag, the box, whatever it is, measure it, and then line out a 50% move and a 100% move. Those would be the measured moves from that box. Now, I happen to already have a fib built into this. So if we are to expand more to the downside, the ADR half is at 39.24. We've got a COG line at 39.11. The roundy at 39 flat. The COG line 39.11 lines up perfectly with my fib line at the 1.236. Love it when things overlap like that. Full ADR 38.91, and 100% of the Globex range gets us down to 38.81. We don't have a market maker move this morning, and we have 15 days left in our active contract. We won't trade it all the way down. Basically, when you come back from holiday next Tuesday, you're probably going to be in the new series. It might not yet. Maybe it'll be until the end of the week, next week, the 9th, which would mean when we come back on the 12th, we would be done with it. That feels a little too close, so we'll see how it goes. But we're going to be swapping contracts soon, and then we'll be in the December series. So definitely want to keep your eye on the active volume. That's how you'll know it's time to change if you're on, say, Ninja or Trade-of-8 or something like that. The December series will start to have more volume than the active September series. What I used to do when I was newer is I would just watch Thinkorswim because I'm always here anyways. When Thinkorswim decides it's time, it will leave the September series. So what I used to do is if Thinkorswim decided it was good enough to move, I would move. So I would roll my Trade-of-8 contracts on the day that Thinkorswim rolled their contracts. I've had people say, well, I don't use Thinkorswim. All right, well, then just look at the volumes of both. And when the Decembers have more volume than September, go to the December series. Simple enough. So we got our downside targets. Turning on the additional cogs for a moment, because I always forget there's a 31 in there somewhere. There is a cog line at like 40.31 or 39.431, something like that. So it doesn't hurt to just turn them on for a moment and see. But I don't. Maybe it's all the way up here. Must be good to go. It's not in that range, so good enough. All right, so we talked about the downside move. If we get back inside the box, if we get back inside of yesterday's range, that's a really big range, relatively speaking. So you're better off breaking those down into quadrants. Think about the Globex low to the RTH high or the Globex high, which they're basically the same thing because that's what we hit our head on yesterday at the open is the Globex high. That would be one zone to focus on. And then the next zone would be from that Globex low to the RTH low of yesterday. That would be zone 2. And then from the overnight hours, from our own Globex low, back up to the low of yesterday. And that would be zone 3. That way you're not trying to take a bite out of that entire apple, right, all at once. There's a lot of pivots in the middle of all of that. Morning, Michael. So with all the pivots in the middle of that for signposts and goalposts, each one would just get you lined up for the next one. Like, all right, we got to the low of yesterday. Where are we going next? To the Globex open. Okay, we got to that. Where are we going next? Daily pivot. And you just keep working your way through each one of those pivot points. There is a possibility that we break out of the top of yesterday. It's a very low probability, right? But we don't want to say that it can't do that, because it can. The ADR for the top side is 40.24, and that's outside of yesterday's price action. So technically speaking, that's within range. We can go there, but I mean, you know, it's a very unlikely situation that we're going to run all the way up to 40.24, especially with how many things today on deck. So, you know, you got to kind of, you got to at least recognize that it's possible, but not probable, right? The volumes were really light yesterday in the grand scheme of things. So definitely want to keep our eye on this today. It kind of ties in with that market chameleon that we were talking about a little bit earlier, and those really extreme numbers. Now, it could have been end of month, you know, it could have been something as simple as that. But those are just some pretty big numbers for the average that we've been looking at. If you look at, you know, like the last 5 days. So, I mean, that's really what it comes down to. Those were just some big numbers for the average. There's always this discussion of calling a bottom, even just a minor bottom. If we're looking for a pivot, either a stabilizing into the holiday weekend or a bump to the upside, which I gotta say, I don't see the rally up before the holiday weekend, maybe after the holiday weekend. So my base case argument is that we're gonna stabilize and hold the line somewhere around that 618 retrace level, right? So basically somewhere in here. And that's like a gigantic Busby. So with that argument in place, if this is where we're going to start building a low, then we're going to want to be looking for that signal that says we're bottoming here and that we're going to rally back up. I'll show you how to do that in a minute. We just want to go ahead and finish the ES first. So for the ES, any rally today to get back inside of yesterday's price, we've got a shallow area at the moment, but that'll get us right into the 4,000 level. And there's a significant amount of volume resistance there. So when we get to 4,000, expect a heck of a fight to get through it. Once we do get through, we should be pretty clear to 40.50. Then we're going to start getting back into that trash again. Above 40.50, at maybe 40.75, we start getting into that nice shallow zone. We should move pretty easy back to the point of control. We're not moving that far in it today, right? We're kind of looking ahead. When we're at the bottom of the box, we have every expectation that we're going back to the top of the box. Now we know that it doesn't owe us that, right? We can be at the bottom of the box, break out of the box, fall out of bed, tumble down the stairs. Of course. But that's the base case argument, right? So the shallow areas kind of imply if we can get through 40.75, we'll move through that shallow zone relatively quick and get it to 41.50. So a nice 75-point move. We do have an overhead point of control that's untouched. So a VPOC 39.92. You could carry forward the value area high from yesterday as well. I don't normally carry that one forward because it's the high of yesterday. I already would have a line there, but you do you. All right. So we basically got all our levels laid out. The market's only down, about 0.25% this morning. We've got the dollar pressing up into that extreme level of chaos above 109.5. And I would expect to see the S&P break below 39 for the VIX. VIX above 28. And I'd expect to see the ES break 39. So kind of some benchmark levels. Bonds broke, well, the 30-year broke a significant level at that 135. If we start to see the 30-year get below 130, I think we're going to see some pretty crazy stuff in the market. Somebody was pointing out to me the other day, the IRX hit a massive level. If you think about the IRX representing, say, the front end of the yield curve or the front end of the curve at the Fed, right? Interest rates and everything that's going on. You got like the front end, the back end. Use something like IFV for your back end. This would be the front. There's this massive level, this trend line. That we're coming up on. And the implications for that, when I tried to dig deeper, the answer was basically, we don't know, but it's not going to be good. So there's this expectation that there's going to be a significant rejection off of this major critical level. And then what? Right? Like literally the answer was just like, buckle up, put your helmet on, crawl under your desk and rock back and forth kind of thing. Oh, great. Well, what are we supposed to do with this? So maybe picking up some hedge material wouldn't necessarily be a bad idea. Now I'm on a monthly chart. This goes back to like 1998. So, you know, think where the Y2K mess was at, or the 07-08 housing crisis, or COVID. Every one of those is where the Fed cut rates. They can't cut, right? They can't. They have to just keep piling them on, and then the levels, the run up into that rejection point. Overlay that thing with something like SPY. So we would start to have a significant market reduction. The Fed would cut to try to help out. Not this time. Not this time. So they don't know. They don't have an answer. But it's worth pointing out, and it's worth noting, because there's a whole lot of head scratching going on with the what's going to happen when we get to that spot. Just wanted to share that with you guys. It's IRX. All right, so I talked about calling a bottom. It's almost impossible to call a bottom on the idea that we can get it right every time and say, oh, the low is in. It's time to buy. Not necessarily, but there's a lot of things that we can look at to kind of get some more validity to the idea that this may be where we're bottoming and beginning to build a base, perhaps, before rallying back up. Even the shorter term, short duration stuff, right? These minor pivots where we run back in the other direction. One of those is a more modern point of view, because we didn't have this kind of data, say, 10 years ago or 15 years ago. It's looking at options volume flow. Thinkorswim has options statistics down here. They invented this thing called sizzle. It basically just means 5-day average. So stock sizzle is 5-day average share volume. Volatility sizzle is the 5-day volatility average. And then put sizzle's 5-day put volume, call sizzle's 5-day call volume. Sizzle index is put call volume over the last 5 days, puts and calls combined. If you go in and read the documentation on Thinkorswim, when we want to try to figure out ratio, every broker, kind of approaches with their tools differently. For Thinkorswim, a lot of their tools starts with a ratio of 1.0. So with the sizzle index, if it's sitting at 1.0, then it's at 1. It's at 0. We're not above the average. We're not below the average. We are the average at that point. A sizzle index of 2 would say that we're at 100% above the 5-day average. An index of 3 would say that we're 200% above the average, right? You see how it goes. So just subtract one number from what you see. If it's not even to a 1 yet, and we're not at a 1 right there, right? We're below the 5-day average. We're not even yet at our average. When you're calling a bottom or looking to call a bottom or seeing if we're beginning to bottom, we want to see a significant level of call volume coming in just across the board. Apple and all the monsters, Apple, Amazon, Tesla, Netflix. It can be done really fast on Thinkorswim. You just jump through the numbers and just look at the call indexes. You want to see a significant level, right? Above the average. And you'll know it's above the average because the sizzle will be pushing like a 2 or 3 or a 4. Not one name. You want to see it across the board, all of them. So that's one way. Another one will be when the VIX rolls over on the MACD. So this bottom line down here, this is the SPX. We had that bottoming in June, July. We had the MACD rolling over before the SPX rallied off those June, July lows. It crossed the 0 line. It had the MACD crossover. And then we rallied off those lows in mid-July. If we're going to call the bottom in the SPX, we need that MACD to have rolled over, crossed the signal line, preferably cross the 0 line, and be in the bottom portion of the MACD. Add that to your call buying in Apple, Amazon, Microsoft, Google, Tesla, the monsters of tech. Now, is it perfect? No, heck no. The MACD is slow. It's an indicator of an indicator of another indicator of another indicator that's looking at price. How far away from price that thing is, it's not perfect. But it took a little while for the S&P to build that base between June and July before we finally started to come out of it anyways. So it doesn't have to be spot on perfect to the day. But those can get you pointed in the right direction. If you don't have those, then, you know, you got to kind of have the argument of what are you looking at to make it think that you're near a bottom or at a bottom? Yeah. The reason I know so much about Thinkorswim is they have a publication. And it's free, thank goodness. It's this thing called the Ticker Tape, and it has all kinds of really amazing stuff, not just Thinkorswim related, but market related. When I wanted to find better ways to articulate volatility, to talk to another person about volatility, I went here and I searched volatility, and I've come up with some really great articles that put it in terms that normal people can understand. Market Maker Move, another thing that Thinkorswim made. They made it up. Well, trying to figure out what it is, right? If they're the ones that made it or made it up, then I went here to figure out how to understand it. Sizzle, Market Maker Move. Thinkorswim uses option. Oh, what do they call it? They don't call it rank. they call it something else, percentile. So trying to figure out where their rank was, I used that same place, the ticker tape. So yeah, lots of really great information there, and it's searchable. So you can go in and you can hunt down for whatever it is that you're interested in. And it's usually pretty timely too. They'll have great articles about like whatever's happening in the current market environment. They'll often do an end of day breakdown too. What happened in the market, what's going on, how to say approach the job numbers or JOLTS or ADP. Really good articles. And it's all free. You don't have to log in. You don't even have to be a client of TD Ameritrade. So pretty cool. So those are, you're going to want to look for that put call, either put call ratio numbers to change, or just, like if you don't have Thinkorswim, you can usually go to someplace free, like go to bar charts, but don't log in, and just look at the put call ratio on things like Apple, Microsoft, those kind of things. And you're looking for that put call ratio number to change. We're back to parity. Although it's still a struggle. There was days where we were just spiking back up and dropping down, but we finally seem to have stuck. We might get that breakout today in the one US dollar Japanese yen. There's another one that I'm looking for, but this little default currency map doesn't have all the pairs. It just has the most common pairs. I'd have to go to stock charts and bring it up, and it's not that bad. Just keep your eye on what's going on out there, especially today. We've had that significant move in energy, but no rotation into anything. We have to get that rotation into tech, or we're going to see some serious volatility issues. So dollar above 101.5, or excuse me, 109.5. Look for that to be a big problem on the market today. The expectation is if we break outside of yesterday's high, we're going to see the S&P come down, break lows, and really start moving down lower. If it decouples, and we've seen that, where the dollar will make a big move and nothing happens. That's a huge warning. So kind of watch for that. Otherwise, we've been having stocks and bonds moving in the same direction. Cats and dogs playing poker. A whole lot of craziness going on out there. All right, things that are moving around in the pre-market. Yesterday, as we came into the open, it was Chinese tech and communications. Those were the only two sectors yesterday through the morning session that did anything of value. Facebook, 3M, Google. See, if we had put that iron on, it would have been great. That would have been a perfect trade. I hope one of you guys got filled, because I didn't get filled that day. Remember, I had to leave. All right, we were getting some weird moves in finance yesterday. So Citigroup slightly bid, Disney, Philip Morris, Google, but they're not up enough. And on the negative side, I mean, we really don't seem to have any crazy negative. And this is the S&P 100, right? So we could do something like jump over to TradingView, count up how many are down this morning, by how much. We need technology or finance if we're going to see that rally. I always forget the pre-market one. SCR, of course. All right, these are the most active this morning. I didn't choose, up or down, just active. With the chip news, AMD and NVIDIA, that's going to make perfect sense. I don't really want to mess with the Qs or the inverted Qs. I don't want any of the volatility ones. So once you strip that out, not a whole lot left in there. just got another report on Finance Juice that 3 more districts in China locked down over COVID. That's really going to whack tech even more today. We're very likely not going to get that rotation into technology, but we've already started the rotation out of energy. So it's likely to get pretty nasty out there today. Buckle up, guys. That's it for me. I'm going to wrap it up. It is my data stream. I'll be in this afternoon. I know it's scheduled for like 1 to 3, but guys, I haven't been able to get that. I keep not hitting it. So it's going to be 2 to 4. I'm going to be reaching out with Lucian, get the schedule changed. We just didn't know. This is the first week of the new schedule, right? And I was hoping that 1 to 3 would work. It's not working at all. So we're going to end up doing 2 to 4, but I'll see you guys there.